computer.
Well, greetings, everyone. I'm Bill Judge, the Dean of Fellows, and I welcome you to our fifth webinar in 2002, and we've got a real special guest. As you may know, Colin Meyer is on the Fellows at ICGS, and I have to say he's one of the few speakers that every time I hear him talk, I learn something new, and so hopefully that'll be the case for you. For those who are members of the Society, we're delighted you're here. For those who are not members, we're especially delighted, and we would hope that you will find some value to this. And if you do, consider coming to a conference and joining us in the future. I don't want to take up much of your time because our speaker has a lot more interesting things to say. I do want to give you a little background. Colin is the Peter Moores Professor of Management Studies at the Business School at the University of Oxford. He's a distinguished fellow of many, many academic societies, including, as I mentioned, the International Corporate Governance Society, but also the British Academy, the Center for Economic Policy Research, and the European Corporate Governance Institute. He was chairman of Oxera Limited between '86 and 2010, so he has some very pertinent real-world experience, and was director of energy modeling at Aurora Energy Research between 2013 and 2020. He was appointed the Commander of the Order of the British Empire in 2017, and he leads the British Academy inquiry into the future of the corporation. Finally, his most recent book, entitled Prosperity, Business Better Makes Greater Good, was published by Oxford University Press in 2019. And I believe he will be sharing some of his thoughts and ideas about that very topic. So, Peter, we're honored to have you with us. Thank you for joining us. We look forward to hearing what you have to say. Or, excuse me, Colin.
No problem at all. Bill, thank you very much indeed for that very kind introduction, and thank you very much to you and Shelby for having invited me to give this talk. Business is going through one of its most profound changes for perhaps the last 60 years. And one of the reasons why it's going through such a profound change is that business is one of the most important institutions in our lives. It clothes, feeds, and houses us. It employs us, and it invests our savings. It's the source of economic prosperity and the growth of nations around the world. But at the same time, it's increasingly being realized to be a source of growing environmental degradation, destruction of nature, inequality, social exclusion, and mistrust. Every year for the past 40 years, Ipso Mori, the UK research organization, has undertaken a survey of 1,000 people in Britain on which professions they trust to tell the truth. At the top, alongside doctors, nurses, and teachers, come, I'm pleased to say, academics and professors. We might not have much power, pay, or prestige, but at least people trust us to do nothing, earn nothing, and take no credit for it. At the other end, near the bottom, come business leaders, just ahead of estate agents, real estate, of marketing directors, of media, journalists, and rock bottom comes politicians. They come just below bankers, trade union officials, and the man or woman in the street.
Colin, I'm so sorry to interrupt. So I just wanted to confirm that there's just a blue screen right now and there are no slides.
That is absolutely fine.
Okay, fantastic.
That's
better safe than sorry. Appreciate it.
Okay,
Thank you.
Thank you. And that has been true for nearly all of the 40 years of the survey, mistrust in business is profound, pervasive, and persistent. And one of the reasons why that's the case is that for much of the past 60 years, there's been one prevailing view as to what the purpose of business is. And that's associated with Milton Friedman and the Friedman Doctrine, in which he says that there's one and only one social purpose of business: to increase profit so long as it stays within the rules of the game, by which we mean to engage in open and free competition without deception or fraud. And that's been the basis of business policy, business practice, and business teaching ever since. But it wasn't always so. Indeed, for nearly all of the 2,000-year history since the corporation was founded in ancient Rome, business has combined the notion of being a commercial organization with delivering a public or social purpose. It's really only the last 60 years that this notion that the only purpose of business is to make money has arisen. Now that's changing. In 2018, Larry Fink, the CEO and president of the largest investment business in the world, BlackRock, said that every business needs a purpose, not a strapline or a marketing campaign, but a statement of its fundamental reason for being. Purpose, he said, is not the sole pursuit of profits, but the animating force for achieving them. And in 2019, we had the Business Roundtable statement on the purpose of business, jettisoning their 1997 statement around shareholder primacy in favor of one that said it's about delivering value to customers, investing in employees, supporting suppliers, caring for communities, and earning long-term returns for shareholders. Now that notion of how the purpose of business is changing is reflected in a number of elements of the way in which economies and business and societies are operating. So, for example, according to the UK Companies Act, company law states that a director of a company must act in the way in which he considers most likely to promote the success of the company for the benefit of its shareholders, and in doing so, have regard to, amongst other matters, the likely consequences of any decisions on the long term and the interests of the company's employees, its customers and communities, its suppliers, and the environment. And there's an increasing realization that it's not shareholder value or shareholder wealth that should be promoted by companies, but the interests of shareholders. Shareholders are people like you and I. They have children, they have families, they have friends, they have communities, they're concerned about the environment, and therefore it's not just shareholder wealth that companies should be pursuing, but as Oliver Hart and Luigi Zingales have said, it should be shareholder welfare. The B Corp movement expresses the view that companies should be delivering benefits that go beyond financial benefits for other parties as well. There are concepts of the mutuality of business and shared value of business, which have gained significance over the last 3 years, and we've seen the balanced scorecard and the triple bottom line have increasing significance. As Bill mentioned in the introduction, over the last few years, I've been leading a program on the future of the corporation at the British Academy, which is concerned with the way in which business needs to evolve and adapt to address the environmental and social problems that it faces, as well as to take advantage of the technological opportunities that are in progress. And as part of that, we came out with the notion of the purpose of business as being to produce profitable solutions for the problems of people and planet, not profiting from producing problems for either. Now, if you think about that statement, producing profitable solutions, what that means is that it's only profitable activities that are legitimate for business. Business is not philanthropy, it's about making money. But what this emphasizes is that profits are derivative of producing solutions. And it goes on to say not profiting from producing problems for either people or planet. So its activities have to conform with regulation and social norms for them to be legitimate. But it's also not a stakeholder as against a shareholder notion. It's not suggesting that one's promoting stakeholder interests at the expense of shareholders because it's pointing to the importance of producing profitable solutions. So this raises the question as to, well, has all of this debate around what really is the purpose of business just been a storm in a teacup and everyone is really saying much the same sort of thing? Or is this really just a storm that's beginning to brew? Well, I'd argue it's the latter, and that really one of the fundamental issues is, what do we mean by the notion of a profit? Well, we of course all know what a profit is in terms of it being the revenue of a business net of its operating costs and its capital costs. But we also realize that there's a great debate that's gone on in accounting theory for many decades, if not centuries, about the notion of profit as being a social construct. And if one thinks about the derivation of the word profit, one can understand why there has been this debate. It derives from the Latin proficere or profectus, which means to advance, and progress. And that notion of progress, I think, is an extremely important one. It's a notion of advancement, progress without regress at the expense of others. It's a notion of wealth creation, not wealth transfer from others or wealth diversion. And it therefore relates to notions of externalities. Externalities, by their very definition, are regarded as being things that lie beyond the concerns or interests of companies. They're not liabilities or assets of companies because they lie beyond its legal boundary. But one of the notions that's really emerging around the debate on purpose is a recognition of the misfit between that legal boundary notion and the effective boundary of a firm. Namely, what a company affects or effects in terms of the changes it brings about is very different from the legal boundary of the firm, which is how the notion of a profit of a company is currently constructed. And indeed, that mismatch is reflected from the fact that companies can profit from negative externalities without acting in an illegal way or necessarily in a way that is reputationally damaging for a company. And it is that which lies at the heart of the problems of the way in which we've constructed business to date. So what is a legitimate profit, or what is not a legitimate notion of profit? Well, clearly, illegal activities are not legitimate forms of profit, violations of regulation are not. But then if one begins to think about the exposure of companies to financial risk, that clearly diminishes the degree of profit of a company, but also the notion of it incurring not only financial risk, but non-financial risk and deteriorations in the reports that it produces on its non-financial activities. And one can go one stage beyond that in terms of what I was just describing in relation to the British Academy definition, and that is not to profit from producing detriments for other parties. And really what lies behind that notion of not profiting from producing detriments is that those forms of profit in which one is profiting at the expense of others are essentially forms of unjustified enrichment. They are forms of what one might in other contexts describe as being theft. But they're a form of theft for which at present there's no notion automatically of defining a liability associated with that unjustified enrichment. But it doesn't stop there, because remember I said that the notion of a purpose was not only about avoiding causing detriment, it's also about the notion of producing solutions and doing it in ways and finding ways of doing that in profitable forms. And that requires a notion of fulfilling the purpose of a company, a positive purpose, and being duly vigilant about the outcomes and opportunities that a business creates in terms of fulfilling that positive purpose. So the notion that emerges is one that's very familiar to many in terms of thinking about shifting beyond a business and just in terms of its inputs and its outputs, to thinking about it in terms of the outcomes of a business. That's to say, the changes it brings about in the world, not just in terms of its customers or its employees, but in terms of also the environment and the communities within which it operates. And then to go beyond the notion of just the changes it brings about, to thinking about, well, what are the impacts of those changes in terms of the well-being effects it has on others? And one can extend that notion beyond just outcomes and impacts in terms of thinking about the opportunities that companies create, the extent to which they enlarge the potential of people to fulfill their own purposes through coming up with innovative solutions which allow them to provide those opportunities to others in profitable fashions. Now, what this does is to quite fundamentally alter our notion of what corporate governance is about. As you'll be aware, the notion of corporate governance is really about thinking of the agency problem that arises in terms of the mismatch between the interests of shareholders on the one hand and those running the company, the business leaders, the executives, and the board of directors, etc. And that's really what corporate governance, as it's conventionally thought about, is viewed as being about, aligning managerial interests with those of shareholders. And it's very much a focus then on how one governs for financial performance. Now, that notion of the importance of financial performance remains central to the definition of the purpose of a business that I was just describing in relation to the British Academy Future of the Corporation programme. So it's not as if the accountability of the board of directors shifts from being to the shareholders of the firm and becomes a much broader notion of accountability. It still remains an accountability in terms of delivering on the profit of the firm for reasons that I'll describe a little bit further in just a minute. But it's important to realize that in thinking about that accountability, there is an associated responsibility. And that responsibility comes from the fact that those profits derive from producing solutions, not problems or not detriments. So in thinking about the governance, it's not only the formal accountability of the board of directors to its shareholders that are important, but also the way in which the company as a whole interacts with all of the other parties with which it interacts and has an effect on. And that notion then of the responsibility of a company and the implication for the way in which it runs its business is fundamentally changed once one recognizes the notion of a profit as deriving from the production of a solution, not a detriment. Now, in some respects, that is already captured in, for example, the UK Corporate Governance Code, which was amended very fundamentally around from what was a very conventional view of corporate governance code, dating back to the Cadbury Commission that set up corporate governance codes at the beginning of the 1990s, to one in 2018, which said that the board of directors should establish the company's purpose, its values, and its strategy, and satisfy itself that these and its culture are aligned. And it then went on in its third principle to say that the board of directors should ensure that the necessary resources are in place for the company to meet its objectives and measure its performance against them. Now, that's a very good summary of what corporate governance basically becomes in this context in terms of determining a company's purpose and ensuring that its values, its strategy, and its culture are aligned with its purpose. The company should ensure that the investment that's needed is being undertaken and that it measures its performance against its purpose and reports against those measures of its delivery of its purpose. Now, that's a good summary, provided that one is clear about what one means by a purpose, because otherwise one gets all of the very bland type of statements that have tended to pervade the purpose seen over the last few years as companies have rushed to adopt a purpose, which is far from a statement of a purpose about profitably solving problems and not profiting from producing problems for others. And so it's only when a purpose has that sort of notion of being a meaningful challenge that putting the architecture of corporate governance codes along the lines of what the UK did in 2018 really makes sense and really has an effect, because the significance of aligning values and strategy and culture, etc., and measurement only works in the context of where you are aligning profits of companies with delivering solutions, not problems. Now, in Oxford, we've been deriving a framework to assist companies and the boards of companies with the implementation of forms of governance that help to deliver on this notion of a company purpose. And we've been working with the boards of some of the largest companies in Europe and in North America on the development of this framework, which we call the SCORE framework, where the 5 letters of SCORE are an acronym for the key components. The first one of which is simplify, to simplify the company's purpose, and that one brings real clarity to it around precisely what problems is a company there to solve, for whom, over what period, why is it particularly well suited to deliver on that purpose, and how is it actually going to achieve it. So bringing real clarity to a company's purpose is the first key component. The second one is then to recognize that this is nothing to do with corporate social responsibility or looking good or promotion of a company. It's about the overarching framework of the company's strategy, so that it has to be connected very directly to the company's strategy. And as Larry Fink said in that quote I mentioned at the beginning, it should be the determinant of what the business does on a daily basis. The third letter O stands for own, to own the corporate purpose, both in a formal sense, in terms of who the shareholders are, who take responsibility for ensuring that the company really is delivering on its purpose. But it's also ownership in a sense of ownership of the purpose throughout the organization, not just at the top in terms of the formal owners or shareholders of the company's purpose or the board of the company, but right from the board down to the shop floor. Everyone in the organization needs to know and understand their company's purpose and their part of that company purpose and how they are expected to be contributing to the delivery on that company purpose. The fourth letter, R, is for reward, to ensure that the system of reward, of promotion, of incentives within the organization are aligned with the delivery of the company's purpose. Now, key to that is the way in which the company measures its performance, and ensuring that the measures that it has of its performance are related to and derived from the company's purpose of solving problems in a profitable way. And the final letter, E, is about exemplify, to bring the purpose to life through narratives, through reporting, through being true to the purpose and authentic in the sense of not only describing and discussing the successes of the business in terms of delivering on its purpose, but also emphasizing the challenges and the failures and the way in which the business is going to address those going forward. Now, the way in which we then link this together to notions of measurement and reporting and accounting is in terms of 3 steps, in terms of, first of all, thinking about this notion of the purpose as being about why the company exists, why it's created, its reason for being, and how that's related to its mission as to what it does, what its strategy is, its vision of where it's aspiring to go, and its values that underpin the purpose and provide the principles that are a basis of the culture in the organization. And then the second step is in terms of the metrics around those components that I was describing about in terms of inputs, outputs, outcomes, what changes from what the business does, and the impacts it has on the well-being of others. That's basically what the company should be measuring. And then what it should be reporting on is, first of all, what is a true profit of a company? Okay, so the notion of a profit that I was just describing is to profit from producing solutions, not problems. So that means that the company has to account for and actually incur the expenditures of rectifying, remedying, mitigating, or compensating for the detriments that it imposes on others. And that in itself is a profound change in the notion of the way in which we think about of a profit. Namely, we think about a profit as being the difference between a revenue and a cost, but not a cost that incorporates this notion of not profiting at the expense of others. That's one approach to thinking about how does one actually create some monetary value alongside the qualitative or quantitative metrics that are used in terms of financial and other reporting. The second is to say, well, one should go beyond that. One shouldn't just think about how does one adjust a profit for the problems that a company is creating. One should think about it in terms of, well, what is the value of the benefits that a company is creating, benefits in terms of societal benefits or environmental benefits, and think about those as contributing to the overall value of the business, the value that the business is conferring on society and the environment. Now, there are clear benefits associated with doing that. That takes it essentially into a cost-benefit analysis in terms of the way in which one evaluates policy decisions in economies. But there are problems associated with it, not least in terms of problems of measurement. The cost-based approach is very straightforward. It's essentially an extension of what accountants do all of the time, to think about the costs, and it's an attempt to establish the true costs, not just a misrepresentation of the true of the costs of a business. But valuation goes well beyond what accountants do typically. It has problems of subjectivity, lack of verifiability, and in general, difficulties in terms of auditing what is being done. But it also has a conceptual issue associated with it, because what it's doing is to ascribe to a company values to society, values to the environment and nature, that the company is not capturing in the revenues it's generating. So the first approach, the enterprise cost-based approach, doesn't attempt to ascribe revenues that the company is not earning, because it's not earning those revenues. So it's not actually profiting beyond that. Whereas the second is basically saying, well, what are the values that the company should be creating, even if they're not reflected in the financial value of the company itself? So that then leads to this relationship between essentially reporting, valuation, and accounting, where reporting is about producing indicators and qualitative measures of social and environmental factors, for example, in relation to CO2 emissions. Valuation is this attempt to move entirely towards monetization, monetizing the values to society and the environment through a variety of different methodologies and techniques. And in between is this notion of accounting for a true profit of a company, where the profit reflects the cost of rectifying, remedying, mitigating, and compensating for damages, including, for example, maintaining, replenishing, or rebuilding societal and environmental assets. Something we think about very naturally in the context of natural assets, natural capital, where maintaining or replenishing nature is something that is routinely thought about. So that then leads to this notion of true profit, which is the current profit minus these costs that companies need to incur in terms of offsetting negative impacts, but also recognizing that some things that at the moment that we account for as current costs, for example, costs expended on training and educating the workforce, which are often treated as current expenditures, are in this context of thinking about a purpose of the business as solving problems, actually investments in nature, investments in society, or in this case, investment in the employees, which are having positive impacts on those parties. And they should therefore be capitalized and depreciated in the normal way in which assets are. And to that extent, profits are actually understated, not just overstated. Now, I want to end by illustrating these ideas in the context of one example. It's an example that comes from one of the most troubled sectors of the economy over the last 15 or so years since the financial crisis, and that's banking. And it's an example of one of the most successful banks, certainly in Europe, arguably one of the most successful in the world, on many criteria. And that success I want to use to illustrate some of the notions of what I've been talking about in terms of purpose, values, governance, trust, and relationships. Its success comes in terms of thinking about what its purpose is. Its purpose is basically twofold. First of all, to be the bank that has basically the most satisfied customers. But it's not only concerned about the delivery of benefits for its customers, it's also concerned about ensuring that it fulfills the profitable solution notion, and therefore seeks to be one of the lowest cost providers of all of its peers. And it's succeeded in achieving this goal for approximately the last 50 years. For example, in terms of customer satisfaction, it is one of the fastest growing banks in the UK, with, as this graph shows, by a very easy margin, the most satisfied customers of any of the main banks in Britain, both individual and corporate customers, but also not only the most satisfied, but also the most loyal customers. And that notion of loyalty alongside satisfaction is very important, because it brings out an important point of the benefit to companies as well as to the environment, societies, customers, and employees from pursuing this approach, namely the reciprocity. Look after your customers and your customers look after you is the message that comes through from this. And that notion of loyal customers and a low cost base is reflected in its financial performance, which is one of increasing returns basically for the last 50 or so years and regularly outperforming its peers in terms of their profitability. It's been a bank that needed no bailing out during either the Swedish banking crisis or the financial crisis. It's ranked as being one of the strongest banks in the world with highest credit ratings, strong liquidity and capital ratios, and because of its resilience, its ability to support its customers through the economic cycle. Now, key to this is the values of the bank. And the values of the bank reflect its governance. Its governance is one in which it inverts the normal governance of a bank. Most banks are run from the top in a very hierarchical fashion. This bank does exactly the opposite. It empowers people at the bottom in the branches of the bank. And it empowers them to the extent that the motto of the bank is, the branch is the bank. And it succeeds in doing that through following a principle of ensuring that everyone is very clear about the purpose of the business and the values associated with it, and that the culture is aligned with the values. It also succeeds in doing this by having another distinguishing feature, and that is that it pays its staff no bonuses. Remember how we're always told that bankers have to earn bonuses if one wants to retain and recruit them. Well, this pays no bonuses, at least until they retire at the age of 60. It's a very long-term incentive scheme. And that notion of delegating responsibility down to the branch of the bank, and not using financial incentives, in essence means that what it does is it puts trust in people at the bottom. And the key benefit associated with doing that is that allows the people in the branches to build up relationships of trust with their customers and to build up long-term relationships. So in essence, what this is doing is to create local banking as we used to know it in a major international bank, where it does that through its governance mechanism of delegating responsibility, putting trust in people, and encouraging employees to put trust in with their customers. And that gives rise to lasting relationships. It's not a transactional basis to the bank, and it creates that loyalty on the part of customers, the financial stability, and its ability to then uphold the interests of the communities in which it operates. Now, does this need a change in law to bring it about? Well, first of all, let me just note that law is changing very substantially. We're getting the emergence of public benefit corporations in US and in Italy. We've got the entreprise à mission in France. We've got something emerging in Germany called the stewardship ownership, which is a form of public benefit company in Germany. There are the changes in soft law in corporate governance, which I referred to in the case of the UK, and Denmark has just adopted essentially something identical to the UK. We've got the extensive regulation in the EU around sustainability. We've got the standard setters, such as the International Financial Reporting Standards Foundation and the International Accounting Standards Board, putting forward standardized metrics against which companies are going to be expected to report in the future. Now, the reason why accountability can remain solely to shareholders in the notion of purpose, as I was describing it, is because the notion of a profit as deriving from solutions, not problems, means that a profit is a sufficient statistic of welfare enhancement. In other words, the profit of a company is positively related to where the company succeeds in enhancing welfare and is negatively related to detriments, which allows them, the shareholders, to have the incentives to ensure that the company is promoting the well-being of others and not exploiting the well-being of others. But it also notes the responsibility broadens to other parties over longer time periods. And that is why the delegation in Handelsbanken was so important, because the board cannot know what is in the interest of every party with which the company engages. It has to be everyone down to the shop floor in an organization that builds up those relationships with other parties. So to sum up, what I've emphasized is that it is not a question as to whether Milton Friedman got it wrong in terms of emphasizing the significance of profits. That's not the issue. The issue is, what is a profit? And the notion of a profit that one needs to derive is one that recognizes the dependence and the impact that companies have, not just on material dependence and impact or a financial one, but their impacts on human, social, natural assets as well as intangible assets. And that then brings out the notion of the boundaries of the firm lying well beyond those of its legal boundaries, and that one has to think about the purpose as being to deliver profitable solutions, not problems, which then makes the profit derivative of solving, not producing problems. That then provides a very natural way of measuring the performance of companies in terms of their outcomes and impacts and the costs of rectifying detriments. And it allows the board to bind the various parties, not only within the company, but also those that it needs to engage with externally, to the purpose and the delivery of strategy. And it does that by essentially aligning the cultures, values, measurement, and incentives with the delivery of the purpose. It's inspiring for everyone in an organization to be contributing towards an achievement of the purpose of producing solutions. And it's also financially lucrative and beneficial for those who invest in the company as well. And I'll stop there. Thank you.
Thank you very much, Colin. That was a very informative and exciting talk there. So we have several questions. I'll be starting with the first one that addresses one of the points that you made about accountability of directors and how it remains solely in the interest of shareholders. So I'm going to call on Habib. Hopefully I'm pronouncing your name correctly. And as he's unmuting, if anyone in the audience has a question that they would like, please raise your electronic hand and I'll be able to field that. Habib?
Hi, Colin. Thank you. Thank you, Shelby. Hi, Colin. Great presentation. Very insightful. I was wondering, so a paper came out in Strategic Management Journal, SMJ, written by Boyvi and colleagues in 2021, where they talk about the implicit theories of the board of directors and what they essentially do on the board. So what they say is that board of directors not only not monitor, but they think that they shouldn't. So it's one of the implicit theories that they do not have enough to go on and monitor. The only thing that they do is providing resources, support to the CEO and so on.
Yeah.
So if that's the case, if monitoring is something that implicitly theorizes board of directors in their mind that they shouldn't be doing monitoring, then this value alignment exercise, is this just a thought experiment that they're doing, or is this something they're actually going to implement?
Okay, well, Habib, thank you very much for raising that, because it's an absolutely central point. And it's central because it reflects precisely the conflict and problem that the current system creates. I mean, I've sat on lots of boards of companies. I've done board evaluations of some of the largest listed companies. And this problem comes across repeatedly. It's the problem of, is the board there essentially to be an advisor or consultant for the executive and the CEO? Or is it there to provide oversight and to discipline the CEO for not doing what they're supposed to be doing. And basically, if a board member shifts from being the former to the latter, then they immediately become essentially disconnected from the company because they no longer have the trust of those in the business. And so effective board governance in terms of providing an oversight and intervening in failures on the part of the executive in the company is very difficult to achieve. And it gives rise to the boardroom battles, which then get into the public press, create an immense amount of disruption for a company. What we need to have is a form of governance in which that notion of there being advisors to the board and the executive do need that type of advisory service are distinct from what I described as being the owners of the purpose. Okay, those are the people who have oversight of what the purpose is, how is the company established to succeed in delivering on that, what are the resources, what is the structure of the company, how is it measuring its performance against the delivery, to what extent is it succeeding and failing, and intervening as is necessary then to ensure that the company is not profiting at the expense of others, and if necessary, intervening to discipline the executive for the failures to do so. And it's because we've conflated both of those functions, the consultancy advisory with the oversight and disciplinary realm, that we have such ineffective governance. And what I mean by having a proper ownership of a company is that there are parties who have the interest in and the responsibility for providing that type of engagement with the executive of a company that then essentially provide the solution to this problem.
Perfect. Thank you so much, Colin. We have a question from Ruth about the implementation of your proposal here. So Ruth?
Hello. Thank you so much for this excellent presentation. I particularly enjoyed your emphasis on profits and how you are reconceptualizing that, because we heard a lot about, there's a lot of work on the purpose, but not so much on the other end. So that was very interesting. I have it's probably a follow-up question. And the first one is, so a follow-up question from what was asked and a little bit of comment on your answer, because I think that is a lot to ask to boards, like from the work that I have done on the cognitive ability of boards and also as a team, is a lot to ask of boards to be the owners of the purpose. Because these directors usually, you know, especially in publicly traded firms, they don't have, at least like the ones that I've worked with, they don't have the skills or even the perspective, or they don't even have the buy-in. So so related to your answer, my question is, and this I get a lot from this decoupling, how can, what a corporation says about its purpose and what a corporation does can be quite decoupled. And we know this is a problem. So in your opinion, where does usually this credibility, this decoupling, this, let's call it purpose washing, might happen? Because, I'm thinking even in the Business Roundtable, we have these 181 companies, and some of them are very, very anti, for instance, unionization of employees. If they are interested in the benefit of the employees as well, and then they're so reticent to their unionization, just to put an example. So where, how do you respond when people, bring this point about purpose washing? What is your response to that? Especially also right now, I'm sorry, I'm finishing here, right now in the anti-walk, I don't know how to pronounce it, but that it's really, really salient in the US. And in the UK, we just had, the the follower of the new prime minister, so that might be also going there. So with this anti-woke movement, so how do you respond to this purpose washing? That's
Okay,
my
well,
question.
thank you
Sorry.
for raising that as well, because that too is a great question. And the answer just to the first part of your question of, is it too much to expect of boards? The answer is absolutely, because it shouldn't be what the board is doing. And that's exactly the problem, that we haven't recognized that we cannot expect non-executive directors to be able to do it. It has to be done by the owner of the business, okay? The owner of the business is the person who has the greatest interest in ensuring that the company is true to the purpose. Because if at the end of the day, the company does not deliver on its purpose and a profit only derives from delivering on its purpose, they get a lower return on their investment. What's been the problem then? Why have we got all of this purpose washing? Because we don't have owners of purposes. Okay, there's no one at the end of the day whose bottom line depends on whether or not that purpose is really delivered. It should, of course, be the investors in companies. But investors, come back to my Larry Fink BlackRock example. If an investor has investments in thousands of companies and globally diversified portfolio, how can one seriously regard that as being an owner of a business? It's not. So what one needs, and the circumstances in which one gets this being taken seriously, and let me come back to my Handelsbanken example, because it is taken seriously there, one needs real owners, that is to say, block holders, people who hold substantial blocks of shares in companies. So in the case of Handelsbanken, it's traded very liquid stock on this Stockholm stock exchange, but it's also got two dominant shareholders, one of which is Industri Varden, which is the Swedish industrial holding company. And it has a direct responsibility, and its bottom line and its financial returns depend on the bank really delivering on what it says it does. Now, there are lots of other examples of where this is done very effectively. The ones that I like to quote a lot are what have been termed industrial foundations or enterprise foundations in Denmark, and there are a lot of them in Germany as well, where, again, the largest company like Svenska, the shipping company, or Novo Nordisk, the pharmaceutical company, are traded on stock markets, but they also have significant block holders of blocks of shares in the company. And those block holders in that case are foundations, okay? Those are owners who've got a real interest because the purpose of their foundations is really aligned with the purpose of the company. So not only have they got a financial interest, they've got a direct interest because of the nature of the activities that those foundations are engaged in. Now, those are examples of real owners where there's a real sense of responsibility associated with delivering on it, and where purpose washing would really be frowned upon within those businesses.
Fantastic. Thank you so much, Ruth. Going from a preeminent governance scholar to yet another amazing governance scholar. So Marguerite, you are up.
Okay. Hi, Colin. Great talk. So I have sort of a very broad sort of issue. I think the framework that you provided is very useful, but useful for what I would call more traditional corporations. And I also think your definition of corporate governance, to me, I think of it quite differently. I don't think of it as an agency issue. Governance precedes the agency conflict. So I think governance is a much more, it's a concept to me that's evolves. It's dynamic, and it's very much influenced by events that happen and also by society, right? Mm-hmm. So it's not just the agency issue. But getting back to the framework, okay? So I think the whole notion of boundaries and profits fits traditional businesses, but the framework doesn't. I can't see it being as applicable or definable, I guess is maybe the better word, definable, when we look at organizations that are not traditional. So if you look at the most valued companies in the world, they're not traditional companies. They're platform companies that operate ecosystems, right? So Apple, Amazon, Alphabet are platform companies. They're the most valuable companies in the world. And so this notion of boundaries is really a difficult concept when it comes to a platform-based business. And in fact, if you think of governance issues that have sprung up over the last few years, they have very much to do, not anything to do with profits, but to do with how platforms have huge societal ramifications that obviously were not thought of when platforms were first thought of as a business model. Okay, so I'm just wondering, how you can conceptualize governance in what I think is, a prevailing business model, i.e., platforms and ecosystems, where you don't have fixed boundaries and you may not even have profits.
Well, thank you for that, Rita. And my answer is those are precisely the examples I cite as being really good illustrations of what I'm talking about, because those trillion-dollar companies are exact examples of what in some respects I described as being problem-solving businesses. That when Larry Page and Sergey Brin founded Google and Steve Jobs founded Apple, etc., they were very visionary leaders about what they were seeking to do in terms of solving problems and solving really big problems. So the notion of viewing their activities as being about solving problems was precisely what they set out with. And the problem that one faces in some circumstances is a lack of ambition, of the nature of what a business should be doing in terms of trying to solve major problems. But the key element of those companies is that they also illustrate not just the notion of profitable solutions, but also of not profiting from producing problems. And therefore, precisely your point about boundaries, that they exemplify extremely well the problem that exists to date, that the notion of the profit of those businesses is defined by their legal boundaries, not by their social and environmental impacts. So they don't take account of the extent to which Facebook is stealing our data, or the extent to which Apple is extracting resources to the detriment of the environment, or the extent to which Amazon has been mistreating its employees in the past. Those are elements that simply lie beyond the legal boundaries, but reflect exactly the issues I'm talking about here in terms of producing detriments and problems. So one of the implications is that their values, $1 trillion above, are overstated, because they reflect not a true profit. They reflect a profit that is beyond the true profit, because they are not incurring the cost of remedying the detriments that they're imposing on others. And that to achieve that, they have to start off by saying, well, what are the detriments? In what way is Facebook mishandling the data that it's using and failing to recognize the legitimate ownership of that data? And what does it take for them to be able to remedy that? And what are the costs? And therefore, what are the true profits? So those platform companies are exemplary cases of precisely what I'm talking about in terms of what's right and what's wrong.
Perfect. Thank you so much, Colin. I think that was a great note to end on, especially since we are Right, exactly at our ending time. So thank you again for a fantastic talk, and thank you so much to our audience members for engaging in the Q&A as well. It's certainly a very prescient topic and one that has no easy solutions at this point. But part of what makes these webinars so useful and sort of like and us so grateful for scholars such as yourself, Colin, is that this sparks a conversation and makes us start thinking about things in a different way, and potentially gives us a framework to discuss this in a much more useful fashion. So thank you so much, everyone. We'll be in touch with our final webinar happening in November.
Thank you. Thank you very much for inviting me.
Of course.